Hi and welcome to the Stephan Livera podcast, a show about Bitcoin and Austrian economics. Today, for episode 243, PlanB rejoins me on the show. Now, PlanB, he's a regular guest on the show. In fact, his first two interviews were on my show, so those are episodes 67 and 86 for those of you interested. And in this show, we talk a little bit about why we believe demand for Bitcoin will skyrocket. And we talk a little bit about his thoughts on how the stock-to-flow and stock-to-flow cross-asset models are going. This show brought to you by Swan Bitcoin. Bitcoin has emerged as a major player on the global stage. It's been significantly de-risked over the past year with major investors, institutions, and companies making big investments. A common way people get started is establishing their initial position with a one-time buy and then start dollar cost averaging with automatic recurring buys. Swan Bitcoin was built to do just this. You can create a recurring purchase plan like $100 a week or $20 a day, and you can also make one-time buys if you want. Swan supports bank wires for larger amounts and ACH transfers for smaller one-time buys. Swan is available in all states and territories of the US, now including New York. Swan is the best place to send your friends and family when they're ready to start buying Bitcoin. Send them to swanbitcoin.com/Livera and Swan will drop $10 of free Bitcoin in their account when they become a member. Lend at HODL HODL is a global Bitcoin-backed lending platform, so you can lend or borrow anonymously on your own terms in a peer-to-peer fashion. HODL HODL uses a secure and transparent collateral storage system using multi-signature for each deal. So this is a way to grow your savings and earn returns on your investments. So for example, if you have stablecoins lying around such as USDT, you can create your offer and earn interest by lending on Lend at HODL HODL. Or the other way around, if you have Bitcoins and you need some liquidity, you can borrow stablecoins by putting up some Bitcoin as collateral without selling that Bitcoin, and you can keep on hodling. So with HODL HODL's Lend platform, you set your own terms and you put up offers depending on how long you want to borrow or lend and interest rates. Go to lend.hodlhodl.com. Nox is a Bitcoin custodian dedicated to ensuring comprehensive insurance coverage for client assets. Much of what passes as insurance today isn't purchased for the sake of protection, but for pure marketing reasons. Nox believes insurance should exist to make fund recovery possible. No sharing coverage between customers. Nox takes a unique approach when it comes to purchasing insurance for customer assets. Coverage is set aside exclusively for every customer in a one-to-one capacity, all with a comprehensive policy covering a range of loss and theft events, including internal collusion. If you are a Bitcoin company, RIA, fund, trust, or family office, make sure to contact Nox to discuss Bitcoin custody and insurance. PlanB, welcome back to the show.
Thanks, Stephan. Thanks for having me.
Yeah, so PlanB, it's been a little while since we spoke, and obviously it's been a very exciting time in the Bitcoin space. So just for context for listeners, we are recording on the 14th of January, 2021. And, as I speak, the Bitcoin price is around, let me just check this. It's about $36,188 in USD terms. PlanB, can you just give us a bit of your thoughts on just kind of where we are in the recent run up and the kind of the sentiment in the market?
We were actually at a place where we joked we would be. We went up. We went up very fast from 10,000 straight to 40,000. And then we crashed, quote unquote, to 30,000. And we have joked about this a lot of times when we were sub 10,000 or even at 20,000. But hey, here we are. And I must say it is for me especially, this is a fantastic place to be, because the model and the research that I've done seems to be getting validated as we speak. It's a bit too early to call, of course, and we're not at the levels we are expecting. But hey, it sure goes up, and it goes up at exactly the time that the model predicts. That is right after the halving, or slowly after the halving, towards targets levels. So yeah, very exciting time.
So in terms of the models, so we've got two main ones to talk about and think about. So we have the OG model, the S2F model, and we've also got the S2FX, the cross-asset model. So in terms of performance against reality, how would you rate them, the two different ones?
Yeah, and it's very well that you say that they're two different models, and maybe to give the listeners some context, and especially the new ones, because there's a lot of new people getting into the space. The first stock-to-flow model was created in March 2019, and it was a time series model. So it looked at the Bitcoin price, and it looked at the stock-to-flow measure, which is a measure to quantify scarcity, and then there's a nice correlation between them, and you can extrapolate that into the future, and then you get to a value that was then quite conservatively estimated at 55,000 end of 2021, and is later adjusted with new data and other coin correction, $100,000 at the end of 2021. So that's the first model, the original OG stock-to-flow model. Then a year later, in April 2020, the stock-to-flow X model, the cross-asset model, was made, and it was basically not a time series model anymore. So it was a model that also uses the same stock-to-flow measure for scarcity and looks at market values, but then across different assets. So Bitcoin is one asset, and I divided phase transitions, and 4 phases within Bitcoin. But then it also includes in the model, so in the data and ultimately in the model parameters, the stock to flow and market value of other assets like gold, real estate, silver, diamonds, and that's what makes it very different from the stock to flow model originally, but also more robust, if you ask me. Important thing is that the price prediction for end of 2021 is also a bit higher. It's $288,000 as an average price in that specific 4-year period. Yeah, and to be honest, I like both models. They're both my babies, but if I had to choose, I would choose for stock to flow X model, because it's not a time series model, so it's more robust. It's always better to have time out of the equation, because we'll get maybe into that later, but if you correlate two time series, there is a big risk of them being and the correlation being spurious, and that risk is less if you don't have time series. And the other big thing is that we can now interpolate instead of extrapolate. If you have a time-based model, a time series model, it can be the number of transactions, can be the time itself, it can be the number of Bitcoins in existence. Then you have to you don't know what the number of transactions in the future are, and to base a prediction on top of that is a risky thing. It's extrapolation. It's based on data that you don't have in your data set. But with the stock to flow X model, we have gold being at a higher stock to flow and real estate being at a higher stock to flow and higher value. So we can actually interpolate within the data that is used to fit the model. And that is a very, very strong argument for this stock to flow X model.
Yeah. Okay, and so probably a good point also to discuss some of the critiques of the modeling. So the thing is, it's kind of shifted over time, right? So there's been this, and I guess we're kind of talking about both the different models, but with the S2F, one of the interesting, I guess, developments was this idea of co-integration, which then later it seems that part has now been shown that we can't apply the co-integration test. From your perspective, what does that mean? Does it essentially just mean we don't have the confidence that would have been provided by co-integration, but you believe that the model might still provide some high-level predictive power? Is that how you would summarize it, or how would you summarize it?
A bit differently. But by the way, I got a lot of critique on the models, which I also invited, because I think the models are only getting better if they're open sourced and discussed. So yeah, the point you mentioned about co-integration was one of the more interesting and very intelligent discussions. So I like that really much. It's important to know that it only applies to the first model, so the time series stock to flow, original stock to flow model, and not to the stock to flow X model. And what it basically says, or what it basically does, it's a measure that protects you or gives you some certainty that it is not a spurious regression, not a spurious correlation, because there is always a risk that you find correlation, that there is no causation or or no relationship at all. It's just a fake correlation. That's always a risk. And let me be clear, that is still a risk. It could be the relation between stock to flow, scarcity, and value could be spurious, although every day that seems less likely. But it is important to make that point. Now, with co-integration, it's actually a test. And that test, if you apply it and it proves co-integration, then the less likely, but not certain, but it's less likely that the relationship, the correlation is spurious, is false. So there's a lot of probability that it is a casual, causal relation and a correlation that you can use for making predictions. But the discussion was quite interesting because it was actually held with a Dutch guy, an Australian guy, a German guy, and me. There were 4 people working on the same data and the same tests. And first, we all did the same tests, and the tests clearly showed co-integration. And co-integration means that the series stick together very closely. The story about the drunk and the dog was made. The drunk goes on the street to walk his dog. The dog is on the leash. Well, the drunk goes everywhere. The dog goes everywhere. But the distance between the drunk and the dog can never be larger than the leash. And that's what you measure, the leash. They stick together, and actually that's what you see, right, in the data. If you look at the Bitcoin price, it sticks to the model, it tracks the model really, really close. And actually, if you do the test, you also measure there is co-integration. But then one of the guys, the German guy, said, well, but hey, one of the assumptions in the test is that both variables are stochastic and not deterministic. So they should be random and not predetermined. And of course, stock to flow is predetermined. So we couldn't apply the test. So although the test showed co-integration, theoretically we cannot, and practically we cannot use it. But it clearly shows the moving of the price around the model. The test also shows it, but we cannot use it. So yeah, that was the end of it right there. You could say, okay, it's we should use another test or develop another test because it clearly sticks to the model, the price. But on the other hand, well, yeah, it's maybe best to be conservative and say that there is no co-integration and probably relationship is spurious. So that was the end of that discussion. On the other hand, if there's no co-integration, it doesn't mean there is no correlation, and the co-integration only works on time series models, so the original stock to flow model. By the time that the discussion was at its peak, I introduced the other model, the stock to flow cross asset model, and there, of course, you see an even higher R squared, an even higher correlation, and we cannot apply the co-integration test over there. Yeah, that was a very interesting discussion at the time.
One other interesting critique that I have seen in terms of so now we're talking about the cross-asset model, the S2FX model, is this idea that when the S2F multiples of different assets, like if there's a variance in one of those variables that goes into it, I think the argument is essentially that the S2F variable dominates that calculation, and then that's what is driving a high R squared. How would you think about that kind of issue?
I think that's true, and we actually did some tests in the stock to flow X model, but also for the stock to flow model. So to include other input variables next to stock to flow, for example, the number of transactions or the time or other variables. And it clearly shows what you already said, that whatever you input into the model, the stock to flow is the main and dominant force driving the price, and that's the case with both models.
Yeah, I see. I guess that would just be a difficult thing if you were going to try to run that on other assets, right? Because we can see that with Bitcoin, but it's not like, I mean, if you're going to try to run those other, like not the price calculation, but with other things on gold and property, that's a kind of a harder thing to do. I guess theoretically, some of those numbers might be possible to create though, right?
You mean the stock? Yeah, well, there's the different aspects. If you do it on other coins, for example, you find no correlation between stock to flow and price. You actually find co-integration and correlation between the price of those altcoins and the price of Bitcoin, but not between their own stock to flow and the price of those altcoins. If you look at gold and silver and other assets, there are not much assets with a large stock to flow, with a stock to flow larger than, say, 2. There's really not much there. Silver, gold, diamonds, real estate, maybe art. Art is a 3 trillion market, but I don't have the data for that. I would be very happy to analyze it if somebody has the data, but that's about it, I guess. And for example, if you look at gold over the same period that we have the Bitcoin data, so since 2009, if we look at the stock to flow of gold and the market cap of gold, it sort of stays the same. It's very stable, and I plotted it in some of the charts. It's the amount of movement in stock to flow of gold and the market price of gold if you plot it, it's within the small dots that I put in that chart. So it's really stable. It's remarkable.
Yeah, and I think you've also been tweeting out recently, or maybe just under a month ago, you were saying RIP to the idea of lengthening cycles and diminishing returns. So why was that?
Yeah, that's one of the other models that's out there, and actually, it's a model I looked before I had stock to flow. It's basically the time model that a lot of guys are using, and that is, I think, for the first time used or published by a guy named Trololo in 2014, and it has this nice curve and it fits the model or the price of Bitcoin very well, but it tends to be not that stable. So it tends to be, you have to adjust it every year to keep it fitted to the data. So the time model is there, but it's also underestimating a little bit, and it doesn't, of course, give credence to the step function that you see in the Bitcoin price, and that occurs after the halving. So if you use a time model, it's a first crude indication, and we have all seen those charts, but it doesn't give any weight to the halvings and the very clear timing of price rise that you can see in the Bitcoin price. That is around a year, 1.5 year after the halvings. It's a nice model, but it's maybe a starting point, but not a very robust one. And now we're at it. I think it also underestimates a little bit, because if you look at the stock to flow X model, you can clearly see that last couple of years, the Bitcoin price was a little bit underperforming to that model. So the phase, if you will, the last 4 years was lower than the model predicted, and that might be due to COVID. The last part of that 4-year period was kind of low. But if you use only that data, that time series data, to fit the curves, then it must be a little bit lower than it must track that lower data in the last couple of months. So that's one. And the other thing, and that's actually the main reason why I said the lengthening cycles and lower cycles theory is dead. If you track the prices without the model, just look at the data, and you compare it to what happened after 2016 halving and what happened after 2012 halving, you see that the price now is right in the middle of those two historic price tracks. And the diminishing cycle theory, diminishing return theory, says it has to be lower. So it states that the next peak will be later and lower than the last. If you look at it right now, it's obviously not the case. It's a bit early to call, I should say, but we're smack in the middle of the last two. So yeah, doesn't look that way.
Right. Yeah. And so I guess to clarify, that would mean that if the diminishing kind of idea is more like it would be at the cycle top would be less as a multiple than last time.
Yes, and current price would be much lower than it is right now.
I see. Yeah. Yeah. And then if we compare something like, say, the stock to flow, and I don't know, so one of the Twitter bots by our friend Bitstein, he's got the S2F multiple, and it's got a really interesting chart where he's basically showing the actual price versus the model price. And right now we're actually above the model price. So, it's like 33,000, 36,000 versus the model price right now is around 28 or 29,000. So I guess what's your view on that idea? Even though we don't have co-integration and that's not part of it anymore, it's just interesting, I guess, to a person looking at that chart that you think, okay, it's really interesting that it's kind of staying inside that range. Now, I guess one critique that someone might be thinking is, oh, well, hang on, these guys with their charting and their modeling, and they keep changing the day, and now it's 463 days and so on. How would you think about that particular issue?
Yeah. The 463 days is a nice thing. I'll get to that later. But first of all, yeah, the fact that the model or the price tracks the model so well, it's actually it's magical to see. Also for me, I mean, you make the model, you trust or you hope it will be right, but of course the proof is in the pudding, and now we see it happening. So it's really magical to see it. I'm very happy about that. And well, we have to see whether it goes to the 100K or 288K, or that we already have had it. But I'm quite optimistic about the 288K. That would be my target. Yeah, about the 463 days. That's actually an improvement that was suggested by Preston, and Preston and I, of course, discussed the models a lot, and and also that site Digitalic. You mentioned the Twitter bot of Bitstein, which is a beautiful thing. And Digitalic has also real time charts on his website. And well, Preston said, okay, you have to ask him himself because he can tell it much better than I. But he said, okay, I see what you did there. You tried to keep the model as simple as possible, only to have the stock to flow as an input. But we also see from last two halvings that the price effect kicked in later. So there is a time lag in price going up after the halving, and we can model that if we just very roughly look at the last two halvings. We see that the all-time high after the 2012 halving was about 13 months after the halving. And for the 2016 halving, that was about 17 months after the halving. So on average, there's 15 months from the halving to the all-time high. And if you multiply that by the number of days, which is in a month, which is then 30 and a half, you get very close to that 463 number. And that's how you calculate it. And when you use that number, the fit will be even better than if you use only the stock to flow variable, because you now have adjusted the average the stock to flow over those 463 days. And I think it's a very nice addition, and it tracks even better.
Yeah, I certainly think it's really interesting that when you look at this chart, that it just kind of seems to stay within these blue bands, and there are times where it goes outside the dark blue band, but it's still within the light blue band, and so on. It's just an interesting chart to look at. But I guess at any point, I guess it depends how bullish we are on Bitcoin. Obviously, all of us we're all bullish on Bitcoin. I wonder, is there, because we really don't know when any of these things break down, right? And when I say break down, I mean like break to the upside, right? Like it may just be that enough people around the world wake up to Bitcoin, start buying it, and then just completely destroy all the models and just completely blast through, right? And this would be more like as I was discussing with Preston, the idea of the final cycle. So I wonder, I guess, as you look at the landscape. What's your thoughts on that idea of, okay, are we just people just gonna start front running the future cycles and just buy it all now? And are we going into a final cycle? Or the counter argument might be something like, well, see, there's just not that many people who are woken up to Bitcoin and putting in enough of their portfolio into buying Bitcoin, so it just can't reflect yet.
Yeah, well, that's a very interesting discussion. I think we will be having that exact discussion for the next 12 to 18 months, at least. So it touches on a lot of interesting aspects, this final cycle discussion. And let me mention a few. One is the efficient market hypothesis, which was also one of the critiques on my model, right? I think Nick Carter wrote a nice piece about it. But the efficient market hypothesis says that all the information that's publicly available should be reflected in the prices of assets. So stock to flow is publicly available. The model is publicly available. It should not be so easy to make money as just to buy Bitcoin now, follow the model, and be rich. So the model cannot be. On the other hand, and then we come to this front run argument. If now we see that the model does work, regardless of the efficient market hypothesis, it does work, and it goes to 288. What happens then? Will people then front run the next cycle? Because for the next cycle, the model predicts a price that's far above $1 million per Bitcoin. So will investors then price that cycle in as well? And the efficient market hypothesis says they will, because the information is out there. We've seen that it works. And if everybody thinks it works, it would be the rational thing to do. On the other hand, and I don't know if I had that same question when the price shot up after publishing the model in 2019, but that turned out to be too early because the price went down afterwards. But we had that exact same discussion back then. And just like back then, I think we will not have a final cycle now, and we will not see we will see some front running or some FOMO, if you will, after 288. So the price will probably go much higher, maybe to $500,000 at the all-time high. But I think the other important aspect is risk. And that was my counter argument at the time against the efficient market hypothesis critique as well. And I wrote an article about that. Yes, the model is out there. Yes, all the information is out there. And it shouldn't be as easy as it seems to be now to make money. Just buy Bitcoin and follow the model and be rich. On the other hand, there's risks. There's perceived risks and real risks in the market. I did a poll on that. And the number one risk that people see is governments banning Bitcoin. And we see a lot of that, of actions in that direction. We see the U.S. Treasury Minister announcing draconian laws over Christmas with a process that's not very democratic. So they're really trying to kill it. And we see today Lagarde from the ECB warning about regulation that has to be made against Bitcoin. Although regulation, of course, is not a ban, it's well, it could be good or bad, but it is a big risk, and people see it as a big risk. And we have governments have barely woken up to the possibility that Bitcoin could be a $1 trillion, let alone a $10 trillion market. So when that happens, they will move, and there could be a good thing or a bad thing, but there is a risk. And another risk is quantum computing. They could break the private-public key relationship. So all the experts say it's not possible, and it's not possible for at least 10 years, and there may be adjustments to the software, etc. But still, it is a risk, and I think those risks, whether true or not, will surface again, especially after the FOMO phase, after we hit the stock to flow target models and maybe beyond. There will be risks and there will be black swan events that make those risks look very real, and we will go down again. So I truly think that will happen. And also that's another argument. The human nature, greed and fear, it will stay the same. So yeah, we probably have FOMO. We will have FOMO once we go up and go beyond 100,000, and we go too high because of greed, and then some risk will surface, and people will be so fearful, and they think they estimate the risks too high, and price will go down. So yeah, I think that will stay the same. That having said, and that's the third big topic this whole discussion will touch. It's the topic of hyperbitcoinization, and that's well, the old Bitcoiners know what it is, but it basically means that Bitcoin goes to the moon, that it will become a unit of account, and that maybe the dollar dies, and Bitcoin will be the thing that we all use to pay and to save money. And yeah, when that happens, that would be the final cycle, but it would be more of a final cycle for the dollar, in my opinion, than for Bitcoin. So it will be the moment that the dollar will end, or will end to exist as the global currency. And I don't think that will be this phase, the phase 5, if you will, but the phase after phase 5. So when Bitcoin will reach a market cap of, well, somewhere in the neighborhood of real estate, let's say 100 trillion US dollars. And I like that number for some reason.
Oh, yeah, I wonder why. But yeah, I think it's if we look at, so just looking at the OG model, the S2F model, it seems to me that, so that model predicted price of 100K for this round. And I think off the top of my head, I think it's something like 300,000 or so for the next round in, let's call it 2024 and the 2025 cycle. And then I think the 2028 halving and then potentially the 2029 bull run, I think it's predicting something in the millions. I mean, really, if we were going to talk about final cycle, I think to me it makes more sense that 2029 might be the final cycle. But I mean, things can change, but I guess that's I guess one way to look at it if you're just looking at the stock to flow model.
Yes, I think, yeah, that's true. So it will be the next cycle after 2024, more in the 2026, 2028 area. But then again, there will always be risk, greed and fear, a total elimination of the cycle. I don't know. Hyperbitcoinization is a really I don't know if it's a good thing or a bad thing to look at, but it will be very interesting. And the front running also, I don't know. I mean, for sure, if we reach that 100, even the 100,000 level, people will think, whoa, okay, well then it might go to 1 million. I better buy some, and well, maybe it goes down, but I'll wait a couple of years. So it will be really, really interesting how that plays out, how that dynamic goes from here.
Yeah, and I think having that regular stacking, dollar cost averaging or auto stacking group of people out there, because those people are in some sense holding up the floor, because after every dip, these are the people running in, and or either they are manually buying the dip or their automated buys are kicking in, and that's kind of in some sense raising the price floor over time.
Yeah, true that. And well, the DCRs are a lot of retail investors, of course. Maybe that's not the biggest driver at the moment, but also if you look at, well, the three big buyers at the moment, Grayscale, who buys every day more Bitcoins than there are mined, and PayPal, same thing, Cash App. So those three buyers buy each alone every day more Bitcoins than there are made. So they have to bid the prices from people that hold them. Well, as we've seen, most of the weak hands have already been shaken out by the volatility. So the hands holding the Bitcoin right now are stronger as ever. I mean, if I look at my own coins, I'm not going to sell. Never, ever. Yeah, up to the next person whether he wants to sell, but you don't get my coins, and they will be harder to get. And it's very funny. I can see that in the on-chain data as well. The shortage, the fact that there's not much coins, and I don't mean the balances on the exchanges that are freaky tweeted about and looked at. I mean, really, the on-chain data, it shows a pattern that is very consistent with the stock-to-flow model and the 4-year cycle, and it shows a shortage that's scary, actually.
Yeah.
Price has only one way to go, in my opinion.
Yeah, and if you look at, well, for example, my sponsor, Unchained Capital, they have some really interesting work, the hodl waves chart,
Yes.
which gives you a nice indicator of, if you will, waves of hodling and how long some people have been hodling their coins, right? So because there's people out there who've been hodling for, multiple cycles at this point.
Yeah.
And so these are people who, I mean, I guess it's interesting, right? Because you make that point, and it's a good point, about how if you add across Grayscale and Cash App and PayPal and others, that's buying more than the amount of new coins created each day, or issued, if you will, by the miners each day. But then I guess the other part of it is old hodlers, because eventually at some price, they might say, okay, I want to take some out and buy a house or buy a car and so on. Because obviously, yes, Bitcoin is going up, but I need to live. I need to look after my family. I have living costs or whatever. And I guess maybe that will become a more of a dominating factor of just how many people are willing to offload, even if it's a small portion, aggregated across millions and millions of hodlers. That small portion can add up to a new amount of supply hitting the market in terms of the sale of Bitcoin.
Yeah, I think that's a key thing you described there. And the hodl wave chart is one that has inspired me since the very beginning to do on-chain analysis and look at the data. The hodl waves are really, if the listeners don't know what we were talking about, Google it, look it up in Twitter and find that chart. The hodl waves basis is really an intriguing way of looking at Bitcoin. I make the hodl charts myself. If you run a full node, you have all the data. So it's really, if you can do a little bit of programming in Python, you can make them yourselves, and you can go a lot deeper than that as well. So, for example, the UTXO set, the total amount of coins in the transactions that are unspent out there, that the changes over time, which is sort of the hodl waves in one dimension, that gives a treasure of information about about how those coins move, who is selling, and it's really unique to Bitcoin as well, because in bank data you don't have that. You would have to have access to all the bank's databases, and with Bitcoin you for the first time you have that. So it's like a heaven for quants and a heaven for people that like to make new economic theories about how this works, this supply and demand game in Bitcoin.
Right, and there are providers as well who do similar kinds of things. I know Coinmetrics do some related analysis, and also Glassnode. So for listeners, I've got an episode with Raphael Schulte-Kraft. He's from Glassnode. He's the CTO, and we spoke a little bit about some of these statistics as well. And I guess one interesting one is looking at, of all the unspent transaction outputs, you can look at how many of them are sitting in a profit and how many of them are sitting in a loss position, and try to ascertain where the market is at from looking at those numbers. Looking more broadly at the macro world of all of this, what are some other, I guess, relevant factors to think about? I mean, it seems every 6 months we get some drama about Tether, and oh my God, Tether is not backed and so on. What's your thought on all of that?
About Tether, I don't think it's a relevant factor. It's a lot of fun. It's really a lot of fun, and it's been there since I'm in Bitcoin. So for years and years, I've heard the Tether FUD, and it's at specific times, right, when the price is sort of wobbly, and there's a lot of things going on, such as with regulation at the moment. Then all of a sudden, you get like I get daily about 50 DMs in my Twitter of people, oh, how about Tether? How about Tether? They put their comments under each and every of my tweet, and my impression is that it's like an army of fudsters that try to spin a story, and of course it gets picked up by people without a brain. So it's nothing. I find there was a podcast, I don't know where it was, but with the two guys from Tether who that was very good. It was last week. It was very good, and they explained how it works, and And why Tether is there, because, the banking system is very slow. If I transfer money to the US or to Australia, it easily take 3 days, where if I want to park some Bitcoin money in cash in US dollars for a couple of hours, that then would not be possible. So yeah, you need a coin, synthetic dollar, where you can park and unpark your money. That goes way faster than the old, slow, traditional banking system. And I get it. And yeah, that's of course the how much the tethers are backed by real dollars and other assets. That's an important thing, and more transparency can be given there by Tether. But it's a very traditional issue as well, with having collateral against loans and future markets that are fully collateralized every day. I guess for people who are not aware or not familiar with those collateral processes, that it sounds very opaque and mystique, and is the stuff that you make a lot of FUD and conspiracies about. But for me, it's a non-issue.
Back to the show after a message for the sponsors of the show, CipherSafe.io. They are producing the Cypher Wheel product. So if you've invested in a Bitcoin hardware wallet, or you have a BIP39 seed, those 12 or 24 words, make sure you've backed it up in a way that's fireproof, waterproof, rustproof, petproof, and tamper evident. Look into the Cypher Wheel. It comes in a wheel shape and it masks the words of your seed, and it also comes with a padlock tamper evident seal, so you can know if it has been opened. Make sure you or your loved ones have access to your Bitcoins if an accident occurs. There's a range of products available on the website at CipherSafe.io, and use the code Livera for a discount. Are you looking for ways to get multi-signature in a guided approach? Unchained Capital are building Bitcoin native financial services, and they can help you achieve this. Their multi-signature vaults are easy to use. They're a web interface. You can get 2 hardware wallets and set them up on your own. But if you need help, they offer a concierge service. Now, they offer this both in a personal context and also in a business context. So you can have concierge calls to walk you through configuring the devices. They'll send you the devices, and they'll send you some Bitcoin to put in the vault also. And they'll educate you on each step in that process. Unchained offer a range of features, such as advanced features for those of you using it for business accounts if you are moving to a corporate Bitcoin standard. So make sure you go and check them out. They're also a great option if you are looking for somewhere to store your keys in terms of your self-directed Bitcoin retirement accounts. So go to unchained-capital.com to find out more. Back to the show. Yeah, sure. And I think it's really interesting that a lot of people just latch on to an explanation, and sometimes they can't find it in themselves to believe that Bitcoin is this genuinely new thing. It is a monetizing asset. It's not just like some little tulip bubble thing, and tulip bubbles don't last for 12 years and continually grow each time and have all this actual utility and networks growing around the people who really use it in the real world, right?
Yeah, and maybe Stephan, it is easy for us having both having a background in banking and institutional investing. But I mean, what I've been seeing since 2008 and 2009, basically since Bitcoin was developed and since the global financial crisis, the amount of quantitative easing and the money being printed by central banks, what they have done last years, is so overwhelming. So it's the only macroeconomic topic. It overarches everything. It's staggering, really, how much money has been printed and what it has been used for. And I've been in a position where I've dealt with central banks on a daily basis, from a bank context with Basel capital management requirements, from an insurance context with solvency requirements, and we've been working. Actually, we've been selling stuff to the central banks for years and years and years, and they buy everything. You know that famous scene in the Big Short where the crew is at a conference in Las Vegas about mortgages and mortgage securities. There's also conferences like that in Europe, actually the same organizers. And at those conferences, everybody, the central banks are there as well, and everybody talks with and about the central banks, because they are the biggest buyer out there. They buy everything. They have unlimited budget. I think if you're in the trenches and deal with the central banks and with quantitative easing, no matter how you call it, can be a semantics game. It has become a semantics game lately, but regardless of that, if you're in the trenches and doing this work, you see the absolute staggering obscenity of it, if you will. It really reminds me of Zimbabwe and Weimar Germany. It can't end well. Well, yeah, we'll have to see. And but knowing the quantitative easing and how it works makes me it's very helpful in making me a big believer in Bitcoin. Yeah, I truly believe that.
Yeah. And in terms of comparing this Bitcoin bull run versus other Bitcoin bull runs, and I know you've been charting them out and trying to show, okay, if this were sort of equivalized with a previous cycle,
Yes.
What would it look like? And we're sort of tracking in the middle of the two other halving cycles.
Yes, yeah. So we had two earlier cycles, which is not much, but we can compare. So that was the 2017 cycle and the 2013 cycle, and they are quite different actually. 2013 was of course very early, and it was in a stage where mining was a big topic as well, because that was the year also that ASIC chips, mining chips, so application specific integrated circuits, so very specific mining chips were introduced and made the security of the network, well, like a million times bigger. And everybody who had that chips had an advantage. So there was huge optimism and, excitement about this step in this next step in the Bitcoin history. And price shot up from I think it was a low of $2.5, average $5 to first $100 and then $1,000 within 1 year. So that was really unimaginable fast and without much corrections in between as well. There was been one big correction, but then 2017, the mining technology was done. There was there's a lot of improvement, but not like that big huge jump like in 2013. So the new thing and the excitement was all about altcoins and ICOs and forks. Everybody was dreaming about tokenized world and new coins, and sort of fintech wave hit the markets, and that craze shot the price up from, what was it, 400 to 200 at the low to 20,000 at the high. So that was also very very nice rise, but it had several corrections in between, like 6 or 7. Very different from 2013. So it had 6 or 7 corrections of about 30% in between in that big rise. And so right now the big question is correction or no correction. I guess part of the answer we already have, because we just had a big correction when price shot up from 10 to 40,000 and then crashed to 30,000, which is 25% minus 25% correction. But it's very, very, if you ask me, it's very similar, and maybe more similar to 2013 price wise than 2017. So we might as well see not that much corrections on our way up. And that is also compatible with the macro environment that we see at the moment. We talked about that the quantitative easing has gone full throttle, of course, since COVID, and more money has been made by central banks and will be made by central banks in the months to come than we have ever witnessed before. So that money has to go somewhere. I mean, that goes to banks, that goes to companies that are saved and would have otherwise default. And all the people, all the managers, but also the employees of those companies, they can go on buying stuff, which is a good thing, of course, but it also keeps the economy going. And in that way, in a very real sense, the quantitative easing money, the printed money, enters the real economy, and it enters the real economy at the top first, of course. So the managers get it first, the politicians and the people that are already rich. So what did they do with it? They buy assets. They buy a second house, a third house, a street of houses as an investment object. They buy gold. They buy Bitcoin. Part of that, and you can quantify that as well in a model. But part of that money will trickle down to assets and also to Bitcoin. So with the amount of money being printed, it's almost unimaginable that we go down from here or have very big corrections. And quite honestly, you can see that in the prices too. If there's a last 3 months, 2 months, 3 months, if there was a significant dip in the price, it got scooped up immediately by buyers. And Michael Saylor was very eloquent in and very open in how he did it, right? How he bought his first 200 million, then the other 400 million, and the other buys since then. He does it very professionally with a lot of help from people that have the equipment and the access to the market, and they sort of move that money without moving the price too much in very small tranches. So yeah, I have the feeling that every dip, every time that the price goes down, there's somebody with stronger hands that will say thank you very much for the coins. They will now end up in my wallet, and they will go in deep cold storage, never to be seen again, or at least in the next 10 years. So yeah, I think we're witnessing that right now, and it feels more like 2013 than 2017 for me.
Yeah, very interesting there. And I guess as we are entering this whole phase 5 thinking, are there any other broader macro themes that you think are worth commenting on in terms of things like, what other kinds of entities we might see entering the space? What kind of, vigor will they be entering the space with? Will they be sort of very cautiously dipping their toe in, or will they start to actually really really dive in, dive in a more deep way to Bitcoin?
Yeah, there are two things I'd like to say about that, and one is the institutional investors are really lining up now to buy Bitcoin. I've been invited almost weekly to join meetings with hedge funds, family offices, banks, insurance companies to talk about Bitcoin, to not only the stock to flow model, but just the whole Bitcoin thing, and how you can buy it, and how you can hedge it, and how you can do it how you have to look at it as an investor. So there's really a lot of demand from investors, and one of the things that I find very interesting also for myself is the derivatives markets. So if you look at the futures market, for example, you can now buy a Bitcoin for, say, $35,000, and you can sell it at the same time for a year later. You can future sell it for more. So for, I don't know what the price is, but $36,000. So you get a certain $1,000 profit. You only have to wait for a year. And of course, you give up your upside, and you also have no downside, so there's really less risk. But you really have to know what you're doing. But anyway, if you do it like that, it's a cash and carry strategy. You can make a 20% return annualized, and that is the kind of returns that Warren Buffett and famous hedge funds get, but not banks or insurance companies. They'll be happy with maybe 5%. So 20% in an easy trade like that is something that cannot be ignored and is seen by more and more people. And some people, put their toes in the water, and of course it works. So more people, it is too good to be true. And add to that a negative interest rate environment that I'm living in Europe, minus 0.6%. You can actually buy you can borrow money for negative interest rates if you're an institutional investor. But even as a private individual, you can lend against your house for 1%, or lend without collateral for 3%. Well, if you use that money, I'm not advising to do that. I'm advising not to do that. But for professional investors, this is candy. This is too good to be true. And then if we look at option markets, we see implied volatilities of over 100%, which means there's call premiums from 40-50%. So you can do volatility harvesting strategies, and which are very, very profitable and cannot be done on other asset markets. So the whole derivatives markets and the relation between the spot markets, derivatives markets, futures, options, etc. I'll be watching them like a hawk, actually participating in them. I see a lot of people entering those trades and looking at it. I think the prices, the future and option market prices, will give us a lot of information about the future. So it's really interesting if those base rates in the future stay that high, if the implied vols in the option market stay that high. And so that's one thing that cannot be denied anymore by the more traditional investors, and that will be seen by more and more. The other thing is not so much investing, but more society thing, and I guess it's a very positive thing. Good money, sound money is very important for humanity. It's good for trade. It's good for specialization. It's good for capital allocation and allocation of scarce resources. Where do you invest? Where not? And to have sound money, a measure, a unit of account that can be counted upon, that can be depended upon, is very interesting and very important. And we don't have that at the moment because central banks are printing the money at will. They're using it for political purposes. They're even weaponizing it. And it's like an architect that uses a measure like the meter or an inch that changes every day. Imagine how a building like that looks after the architects are finished. And that's our economy at the moment. So we're building with a measure that is changed every day. And Bitcoin will, for the first time, introduce a constant, and that is the 21 million coins. So there will, for the first time ever, be a constant in finance, like there is a constant in physics, like the constant of light, the speed of light, for example. Well, in mathematics, and that's from an Austrian perspective. And I talk about this with Stephan lately. That could be very interesting. This constant, and maybe with that comes a sort of predictability, but at least a totally different kind of economy, a separation of money and state. And in my opinion, it will even unleash the next renaissance with science at the very heart of it, but also with art and freedom and a totally different society than we have at the moment that is dominated by governments and states. And this one will be more sovereign, individual, and math and art based. That I find that a very hopeful perspective, and that's maybe, apart from the investing, the main reason why I find Bitcoin so very, very interesting.
Yeah, there's certainly a lot of factors in there that really point to being bullish at this point in time. And some of the earlier points you were just making there, like the cash and carry strategy. Now, obviously, for those of us who are more hardcore Bitcoiner, we wouldn't want to give up the upside of holding Bitcoin. But for somebody who's a little bit more trying to dip their toe in here, this is an easy way for that kind of person to, so long as they have the right institutional setup to be able to achieve that kind of strategy. And I think the other point that you raised that's really interesting in terms of where the next, let's say the next big amount of demand or the next, potential big markets for people who are going to come into Bitcoin is this whole cost of carry, which we're seeing in Europe. Large people who have large amounts of fiat money in their bank accounts are now starting to get charged for that. And well, if we think from a cost of carry perspective, you can quite cheaply hold Bitcoin for a tiny, tiny fraction of the cost that these people are paying to hold fiat money in a bank account. So I think that is just going to really start driving home this cost of holding fiat, whereas historically it was free or you made money out of it.
Oh, absolutely. And it's, for example, in Holland, it's not even small amounts. It's everything above 25,000 euros. You get negative interest. You have to pay. You don't get interest. You have to pay. And I can tell you, the moment that that happens, that negative interest rate is unleashed upon your savings, then the demand for Bitcoin will skyrocket. I saw it happening around me with friends and family. I saw it at work. I saw it in the whole country. Everybody is scrambling to get his money out his negative interest rate bullshit. It's really, it's unimaginable what that does psychologically, and of course it just eats your money away.
Yeah, it's a very big injustice, and hopefully more people start to see that, and I think they will see that over this next couple of years. But I guess with all that said, it's probably a good point to wrap it up at this point. So listeners, make sure you follow PlanB on Twitter at 100 trillion USD and find his website, planbtc.com. Anywhere else you would like to point people, or is that essentially the main places to find you?
Twitter is the main place. I do have a website with it's planbtc.com, and it has all the podcasts and articles. So the 3 articles I wrote. But Twitter is the main thing, and reach out if you will. The DMs are open.
Fantastic. Thank you for joining me again, PlanB, and hope to chat again soon.
Thank you very much.
So make sure you find my show at stephanlivera.com. Also, would appreciate any reviews you can leave me on platforms such as Apple iTunes, or if you just share the show with your family and friends, make sure they are also learning about Bitcoin. Thanks. That's it from me. I'll see you guys in the Citadels.